All right, how's everybody doing? Patrick here, Prime Ag, another weekly webinar. We're going to cover selling bean calls. We got a little bit of action in the bean market and the grain markets in general, some dryness in South America. So we've had a few questions. A couple guys called in asking about selling some bean calls for next year. We'll put together a little presentation on that. So let's jump on in. Basically what we're looking at, selling a $13 or higher November 22 bean call. Why would we do something like that? Well, you get to collect the premium through time decay or price volatility. And then what is the risk? If beans get called away, can you live with the sale? And, you're going to have some margin calls for about 10 months. These option calls are going to expire at the end of October. So if you hold them all the way through, you can, you have the potential for some margin depending on what the bean market does and how volatile things get in here. So, right now, looking at the $13 call for November 22, you can sell it and collect about 65 cents. So that comes out to about $32.50. Less commissions. For us, it's about $0.015. So you'd net out 64 cents on that. And then just a kind of a quick breakdown of how that would work if at the end of October 22nd, when these options expire and the beans are below 13, you're going to keep all of your 65 cents. You put that in your pocket. If at the end of October 22nd, no beans are above 13.65, your physical bean price is going to be maxed out at 13.65 futures. So again, when you sell these calls, you do have to be okay, or you're going to have to be able to live with the price you get called away at. So basically what this second part is telling you is that if beans are at 15 on October 22nd, if you were to sell one call that covers 5,000 bushels, that 5,000 bushels of beans are going to net out at 13.65 rather than the 15 that the market's at. Now hopefully you have some more bushels to sell, you can bring your average price up. But again, just kind of want to let everybody know that that's how that works. And then of course you can always exit the option any time between now and October 22nd. But keep in mind volatility and time value will have an impact on premium. Let's look at the chart. We'll kind of go over some of those things. So continuing on here again, selling that $13 call for 65 cents. Another one we looked at, you could sell a $14 call for around 30, I believe. Keep in mind there is no downside protection. All you're doing is you collect your 65 cents, but no bushels are sold or protected to the downside. So if beans were to break, they're at like 12.50 here right now. If they were to break to 11.50, yeah, you get your 65 cents, but that's not enough to make up for the dollar move that beans just fell. So something to kind of keep in mind. And then obviously the next point, roughly your break even right now is 12 bucks, but it's just going to depend on if beans were to break at what time. Okay, so if they break sooner rather than later, there's probably going to be some option premium still in these. On the other hand, if they were to break in September, the time value is going to be eroded away, so you'll be able to collect a lot more of that premium. So all that's to say is basically, these take a little bit of management. There's nothing to really be afraid of, but they do take a little bit of active management just to kind of figure out where you need to move the physical at as the beans come down. But what you'll see a lot of guys do is if you get a decent down move, these options might lose 10, 15, 20 cents, cash out, put that 20 cents in your pocket, and then look for the next opportunity. So really, here's how it looks on a chart. One of the reasons why we chose 13, obviously, is that's near the contract highs for Nov 22. So if you're looking at this, you say, hey, I wouldn't mind selling some beans at 13. If we get there, then maybe selling this call is right for you. Like I said, when you collect that 65 cents, that actually brings your net price up to 13.65, which is that orange line right there. So we do need to keep in mind though. Last year, if we were to look at a continuous November contract, I think beans peaked out at about 16. So, depending on how you want to look at it, there's still a possible $3 to hit the highs of last year. But again, let's just say that you did this and the beans went to 13, you get called away, and they start working their way up to 14 or 15. You could continue to sell calls and collect that premium while offsetting bushels as the market climbs higher. So it's a little bit, some might call it a bullish strategy. If we stay in a range, you could consider it maybe a bearish to neutral strategy. But again, we just had some questions in here on these options. So we thought we would put something together for you. You can see as well, bottom of the range here is about 12 bucks. So you get down to that $12 level and you really need to watch these calls, maybe take them off the table because you might need to sell your physical bushels because again, you really don't want to have this market, let's say, break down to 11.50, $10, $11, collecting 65 cents doesn't really do you a lot of good if you're still holding a bunch of beans and prices are down that low. So wrapping things up, again, really what you get to do is you get to take the time advantage of the time value here in the bean market. It works for you and it works against you. 65 cents is an attractive, certainly an attractive number. But again, you do have 10 months to potentially hold this and go through the volatility. So, again, too, as we pointed out, beans are at about $12.50 here for a new crop. If you did get called away, you'd be getting $1 higher than what you did today. So, in some respects, I think that's a good thing. Again, if the market continues higher, you're going to have to strategize and either continue to sell more calls or just have physical bushels to sell higher and raise your average price up. Finally, if the market stays within the $12 to $13 range, you'll get to keep this premium. Puts that 65 cents in your pocket, keep your bushels, and kind of figure out, the next move of how you want to market. Your downside protection, like we said, is limited to that 65 cents that you collect. So, keep in mind this is all on the board, so you're not selling any physical bushels. And then lastly, of course, you do have margin calls on this. Depending on what happens through the summer, South America, our spring planting, etc. You can see some volatility swings in here. The premium could jump 40 cents, it could jump $1. So you do need to budget some dollars for margin calls. Again, it's not something to necessarily be afraid of. Just be aware of it, and plan for it. So if you guys have questions, something you'd like to do, if you'd like to look at some of the other option strikes out there, give us a call, shoot us an email. Both will be in the description down below. Again, if you find this video helpful, please hit the like button. And be sure to subscribe to our channel so you guys can get notified, when we do post some new videos. We hope everybody has a Merry Christmas, and we will see you again next Tuesday. Thanks.